Welcome to a new Deep Dives, where we take the latest company updates and distill them into clear, actionable insights for you. Today, we're plunging into the first half 2025 earnings call of Enel, the Italian multinational power company.
That's right.
And this isn't just about, reading headline numbers from a report. Our mission today is really to understand the strategic pivots, the underlying drivers of performance, and what these results mean not just for Enel, but maybe for the broader utility landscape too. We're going to sift through the data, connect the dots, and hopefully uncover the story that's unfolding.
Indeed. We're looking beyond those initial market reactions. We want to uncover the deeper narrative of Enel's execution and its strategic alignment. This deep dive should help you grasp not just what happened in their latest results, but more importantly, why it matters and what signals are being sent out. Can Enel's strategic pivot truly de-risk its business and justify a higher valuation? Or are there maybe hidden challenges beneath the surface? That's what we're here to explore.
Okay, good. So let's kick things off with the immediate takeaways. Enel's first half 2025 results reported July 31st. The numbers look pretty compelling at first glance.
Yes, they did.
The company delivered an ordinary EPS of 0.38. Now, ordinary EPS, earnings per share, it's a key profitability measure, right?
Right, per share profit.
And it comfortably beat the street estimates of 0.35. So that's a solid 9% beat on net ordinary income.
It's pretty significant.
Yeah. And revenue also came in strong at $40.816 billion. That topped estimates by about $0.6 billion and showed a robust 5.4% increase year over year. So pretty good start to the year, wouldn't you say?
Absolutely. And on the operational side, we saw ordinary EBITDA, that's, earnings before interest, taxes, depreciation, and amortization, a core profitability metric. It reached $11.468 billion. Now, that was only a slight 0.9% increase year over year, largely in line with what analysts expected, but maybe more significantly, group net ordinary income, which gives you a clearer picture of the actual profit for shareholders, that grew a healthy 4.4% year over year. So solid, steady growth numbers there.
Okay. And what about the balance sheet? Debt is always a big topic for utilities.
Right. Well, net debt stands at $55.447 billion. That's actually a modest 0.6% reduction since the start of the year. What's important here, though, is the net debt to EBITDA ratio. That's a key leverage metric. It's holding steady at a pretty manageable 2.5 times.
Okay, 2.5 times. That suggests some financial stability.
Exactly. And notably, the board approved the first tranche of a pretty significant share buyback program, up to $1 billion. And that's part of a larger $3.5 billion authorization they have. That's a strong signal to the market about confidence in cash flow.
Yeah, definitely a signal. And management seemed pretty confident, too.
Oh, absolutely. They wasted no time stating their confidence. The CEO, Flavio Cattaneo, highlighted continued value creation and, importantly, an improved risk-return profile. They're clearly expecting net ordinary income to land, quote, at the high end of guidance for the full year.
So pushing towards the top end.
Right. He even said the company is, and I quote again, moving from promises to delivery and from delivery to the result. It's quite a bold statement, but, the numbers do seem to back up that narrative of execution.
Okay, so beyond these headline numbers, what's truly driving Enel's strategic shift? How are they executing it? Let's unpack this and dive a bit deeper into their direction.
Yeah, what's truly fascinating here, I think, is how management talked about the earnings profile evolving. They noted it's increasingly decoupled from power price volatility. Now, this isn't just a casual observation. It's a very deliberate strategy. They're aiming for lower risk, greater visibility, and, enhanced resilience in their earnings.
Right. In a world where energy prices can swing wildly, that stability is crucial. It's a big pivot.
It's a critical pivot, exactly. It lets them navigate this volatile energy landscape with much more predictability. It fundamentally changes the risk profile of the business.
So how are they actually achieving that decoupling?
Well, they're focusing on their core markets and, crucially, on regulated assets, things like electricity grids, the infrastructure that gets power to homes and businesses.
Okay, the poles and wires?
Essentially, yeah. These assets generate stable, predictable revenues because their returns are largely set by regulators, not by fluctuating energy prices.
Right.
And they're putting their money where their mouth is. Over 55% of their capital expenditure went directly into these networks. That really locks in stability and long-term visibility.
And they're focusing geographically too, right?
Yes, a whopping 80% of their total investment was strategically deployed in what they see as lower-risk European markets, again, reinforcing that stable revenue stream.
Okay. And do the operating numbers, the KPIs, back this up?
They do, yeah. The KPIs really confirm this strategic progress. For instance, the Italian regulatory asset base per customer reached 658.
Sorry, that regulatory asset base, the RAB, that's basically the value of assets they can earn a regulated return on.
Exactly right. So a higher base per customer generally translates to higher, more stable revenues. It boosts the profitability of those assets. And critically, renewables now account for an impressive 73% of their total production. Emission-free generation is about 85%.
Wow, 73% renewables.
Yeah. And this isn't just, good for the planet. It's a strong hedge against volatile fossil fuel prices. In fact, 93% of their fixed price sales are now covered by renewable sources. It shows how deeply integrated this de-risking strategy is.
And this focus on renewables, it's showing up in their M&A too. You mentioned acquisitions.
Absolutely, especially through what's known as brownfield acquisitions.
Right, buying existing assets, not building new ones from scratch.
Exactly. It allows for faster integration, quicker revenue generation. They've been pretty active. They acquired over 1 gigawatt of renewables in Australia. They also did an asset swap deal in the U.S., adding 285 megawatts of consolidated renewable capacity, and just recently acquired 155 megawatts of wind assets in Greece. These aren't small moves, they're significant steps.
So these deals are all about boosting that predictable cash flow and being smarter with capital.
Precisely. Sharpening capital discipline, lifting predictable cash flow that's crucial for a utility. And it complements the earlier divestitures, the asset sales. Remember, they shaved off an impressive $9 billion from net debt in just 12 months through those sales.
$9 billion, yeah.
And management says that disposal plan is now largely completed. So it signals a very clear shift away from being that maybe sprawling global utility they once were, to becoming a much leaner, integrated RES plus grids operator, focusing on renewable energy sources and regulated grids, high return, low risk areas.
Okay, leaner and meaner. And what about efficiency, cost savings?
Oh, they're hitting that hard too. They've already achieved $1 billion in cash cost savings. That's an impressive 67% of their 2027 target.
Wait, 67% already? They're well ahead of schedule.
Exactly. 2/3 of their 4-year target achieved basically in the first half of 2025. This commitment, plus that new $1 billion buyback, it really signals strong confidence in their free cash flow durability and their commitment to shareholder returns. Tells us they expect to generate significant cash.
Okay, so the underlying story sounds pretty positive, focused on stability and efficiency.
Great.
But there were some headwinds mentioned, right?
Yeah.
External factors.
Yeah, we do need to acknowledge those. Currency devaluation, mainly from the Brazilian real, did create a drag of roughly $270 million on earnings.
Well,
It's a headwind for sure, but management views a portion of it as non-structural. They think it's partly tied to the euro strengthening against the US dollar rather than deep issues in Brazil itself. So more of a currency fluctuation.
okay, so potentially temporary. And what was the issue in Spain?
Yes, Spain. An unexpected hit of about $150 million from ancillary service costs, partly due to a blackout, apparently.
Ancillary services, like grid balancing, backup power.
Exactly, things needed for grid stability. And while $150 million is noticeable, management anticipates these costs should fade quite significantly in the second half of the year, suggesting it's more of a one-off temporary issue, not a recurring problem.
Got it. Okay, so despite those bumps, they reiterated their full year guidance.
They did, stuck to the full year 2025 targets, expecting ordinary EBITDA between $22.9 and $23.1 billion and net ordinary income between $6.7 and $6.9 billion. Reiterating guidance despite those headwinds, that speaks volumes about their confidence.
Yes.
And structurally, networks are projected to maintain that strong 40% share of EBITDA in the second half. Interestingly, Latin America is expected to see a slightly growing share versus Europe, maybe highlighting some targeted growth there.
And how's the retail side doing, particularly in Italy? There was some churn there before, wasn't there?
Yes, but performance there is stabilizing now, which is crucial. They completed a significant customer base repositioning, basically shedding less profitable customers or adjusting terms. That did temporarily impact results, as you said, but now the churn is reduced. And get this, it's actually extended the average customer lifetime by about 2 years.
Oh, wow. So turning a short-term pain into a longer-term gain.
Pretty much. It's a key stabilization point for that market.
And what about the broader demand picture? Macro trends.
On the macro front, power demand looks positive in the Americas, particularly in the U.S., driven by that explosive growth of data centers. They just consume huge amounts of electricity.
Right, the AI boom effect.
Exactly. And Spain is also seeing demand aligning pretty well with its GDP growth. Italy, however, is experiencing flatter demand, seems less influenced by broad electrification trends there and more by specific weather patterns.
So a mixed picture geographically.
Yeah, it means Enel needs to be nimble across its different regions.
Okay. And one last technical point, the Italian WACC reset. That sounds important for a regulated utility.
Yes, the WACC, the weighted average cost of capital, it determines how much they can earn on regulated assets like the grid. While the 2022-2024 period saw a slight reduction in that allowed return, down to 5.6%, they said positive impacts from managing operating expenses and inflation adjustments have largely compensated for it.
So they managed to offset the regulatory change.
It seems so. It demonstrates the robustness of their baseline approach, even with regulatory shifts, shows they can handle those changes effectively.
Okay, thanks for breaking that down. Now, let's put this into context for, anyone listening who might be following the stock. How did the market react?
Well, the immediate reaction was, interestingly, a mild dip. Enel stock fell about 0.56% the day after the call. Small dip, but telling.
So, despite the positive underlying message, a slight negative reaction. But was there more to it? Trading volume. Options.
Good point. That slight dip came with a significant volume spike. Trading volume was up 70% compared to the one-month average. And perhaps even more telling, we saw open interest in the August euro, 8 call options rise by around 40% compared to the prior week.
Okay, so higher volume and a jump in bullish option bets at the 8 level. That's quite a divergence from the small stock dip.
It really is intriguing. While the market, or some parts of it, might have fixated on those temporary headwinds, the Spanish costs, the FX drag sentiment on both the buy side and sell side remains largely bullish.
They're looking past the noise.
Seems like it. They're recognizing the underlying cash flow resilience and the leverage improvement. Even with a recent downgrade from Morgan Stanley, which tempered things slightly, you still have a mid-70% buy ratio across sell-side analysts.
Mid-70s is still pretty strong consensus.
It is, and you have to look at the longer-term performance, too. Over the past year, Enel has significantly outperformed the main European utilities index, the Eurostoxx 600 utilities. Enel delivered a 24% return compared to the index's 11%.
Wow, more than double the index.
Yeah, it speaks volumes about the market generally appreciating their de-risking strategy and portfolio reshuffle, even with these minor temporary bumps.
So looking ahead, what should people be watching for? What are the near-term catalysts?
Okay, key things to watch. Definitely progress updates on that first $1 billion buyback tranche. We'll likely hear more at the Capital Markets Day in October. Also, keep an eye out for the imminent ARERA concession terms for the Italian grids. ARERA is the Italian regulator, so those terms are crucial for their grid earnings.
Right, the rules of the game for their Italian network.
Exactly. And potentially more brownfield acquisitions in the U.S. and EU, which would further cement that renewables and grid strategy. Of course, the November 9-month trading update. Any shift in full-year guidance then would be a key checkpoint.
Okay. So the core story really remains this evolution towards being a leaner, focused renewables plus grids operator.
That's the takeaway. If management keeps converting that asset rotation, selling some, buying others into higher earnings per share and lower debt, well, this multi-year de-risking story could justify further multiple expansion.
Meaning the stock could be valued more highly by the market as it becomes seen as a more stable, predictable business.
Precisely.
All right, this is the part of the show where we get a little creative, we float an idea, maybe something a bit out there. And just to be crystal clear, this is purely for entertainment and conceptual exploration. It is absolutely not financial advice. All investments carry risk. Please do your own research.
Definitely not advice. But given Enel's strong H1 results, that slight, maybe puzzling market dip post-earnings, and the strong underlying strategic story, here is an outrageous but plausible idea for the more adventurous listeners out there, based on how the market reacted versus maybe the fundamentals.
Okay, let's hear it.
Consider initiating a long position in Enel common stock itself, to capture that fundamental value story we've been talking about. But here's the twist. Simultaneously, initiate a long position in out-of-the-money call options, specifically targeting those August euro calls that saw that big jump in open interest.
Okay, so buying this stock for the long term, but also buying call options, the right to buy at €8, hoping for a quicker pop. Explain out of the money.
Right. Out of the money just means the strike price, €8 in this case, is higher than the current stock price. These options are cheaper because the stock needs to move up significantly just to break even. But if it does move up quickly, the percentage gains on the options can be much larger than on the stock itself. It provides leverage.
So the thinking is you're betting the market quickly realizes those headwinds were temporary, sees the strong fundamentals, and the stock rebounds towards or past 8, while the options give you extra juice on that rebound.
Precisely. That 0.5% dip, the fixation on Spain and FX, arguably, it looks like a short-sighted reaction. It seems to overlook the solid Italian retail stabilization, that big buyback signal, and the whole ongoing de-risking narrative. The options activity itself suggests some sophisticated players might already be positioning for exactly that kind of rebound, seeing the dip as a transient mispricing. So this strategy, it lets you participate in potentially rapid upside if the stock corrects higher soon, while your main equity position captures the longer-term value as Enel executes its transformation. It's sort of an asymmetric bet, limited downside on the options cost, but potentially magnified upside betting on a short-term market inefficiency, coupled with conviction in the long-term strategy. A dual play, if you will.
Interesting.
Yeah.
A way to play both the short-term reaction and the long-term story. But again, and we have to stress this.
Absolutely. Purely conceptual, not financial advice. Do your own homework. Options are complex and risky.
Right. Okay, and that wraps up our deep dive into Enel's first half 2025 earnings.
You know, what really stands out to me is just the clarity of the strategic execution. Despite those temporary external headwinds, their focus seems unwavering. De-risking, optimizing capital, driving predictable cash flow through grids and renewables. It feels like they're firmly on track towards a more resilient, higher quality business model.
Yeah, they're reiterating guidance, returning capital, positioning themselves for the long term in this shifting energy world. It really is a story of transformation, isn't it? From that broad utility to a more focused powerhouse.
It is, and hopefully this deep dive provided some insights that go beyond just the headlines. We'd encourage you to think about the implications of these kinds of strategic shifts for the whole utility sector. You know, how will this trend of de-risking and focusing on regulated assets reshape the future of energy investment? That's a big question worth pondering.
Definitely something to think about. Thank you for joining us on this deep dive. As always, please remember this discussion is for informational purposes only and is not financial advice. We hope you gain some valuable insights into Enel's latest performance and strategic direction.